Understanding dividend traps. How to spot and avoid them before they wreck your portfolio. When diving into the world of investing, dividends often emerge as a shining beacon of passive income. Many investors are drawn to the allure of consistent cash flow, envisioning a future where dividends could fuel their retirement dreams and help them break free from the grind of a traditional 9-to-5 job. However, the investing world isn't without its pitfalls. One of the most dangerous traps for dividend investors is the dreaded dividend trap. In this comprehensive guide, we'll explore what dividend traps are, why they occur, and how savvy investors can identify and avoid them before they wreak havoc on their portfolios. Drawing from real-world examples and expert insights, this blog aims to equip you with the knowledge needed to steer clear of potential financial landmines. What is a dividend trap? A dividend trap occurs when investors are lured into purchasing a stock primarily because of its unusually high dividend yield, only to find out later that the dividend is unsustainable. This often leads to dividend cuts, declining stock prices, or even financial losses. Dividend traps are particularly dangerous for income-focused investors who rely on dividends for passive income. A sudden cut in dividends not only disrupts income streams but can also lead to a steep drop in the stock's price, amplifying losses. Why do dividend traps happen? Several factors can contribute to the formation of a dividend trap, including financial instability. Companies facing declining revenues, rising debts, or shrinking cash flows may struggle to maintain dividend payouts. Cyclical industries. Stocks in industries with volatile earnings, e.g., oil shipping, may offer high dividends during boom periods but cut them during downturns. High payout ratios. When a company distributes a large percentage of its earnings as dividends, there may be little left to sustain the business during tough times. Value traps. Some companies appear to be good deals due to low valuation metrics but are actually in a prolonged decline. Debt pressure. Excessive debt can force companies to cut dividends as they prioritize debt repayment over shareholder payouts. Key warning signs of a dividend trap. 1. Unsustainable dividend yields. A high dividend yield can be tempting, but it often signals trouble. A spike in yield may be due to a falling stock price rather than genuine income growth. For example, during the pandemic, ExxonMobil's dividend yield surged to over 9% due to a sharp drop in its stock price. While ExxonMobil eventually rebounded, not all companies are as resilient. 2. High payout ratios. A payout ratio indicates how much of a company's earnings are being paid out as dividends. When this ratio exceeds 70 to 80%, it could indicate that the company is stretching its resources too thin. Sectors like utilities might sustain high payout ratios due to stable cash flows, but for most sectors, it's a red flag. 3. Rising debt levels. Companies with mounting debt may struggle to maintain dividends. For instance, AT&T's massive debt load contributed to its dividend cut, showing how debt can turn a promising dividend stock into a potential trap. 4. Declining earnings or cash flow. If a company's earnings or cash flows are declining while it maintains or increases its dividend, it might be using debt or cash reserves to pay shareholders, a strategy that is rarely sustainable long-term. 5. Negative market trends. Stocks in declining industries, such as traditional tobacco or fossil fuels, might offer high dividends to attract investors despite facing long-term headwinds. Altria, MO, is an example of a stock with a strong historical dividend record, but future growth prospects may not match past performance. Real-world examples of dividend traps. General Electric, GE. Once a dividend aristocrat, GE fell into a classic dividend trap as declining earnings, high debt, and structural challenges forced the company to cut its dividend multiple times. Investors who held on for the dividend income suffered significant capital losses. Wells Fargo, WFC. During the pandemic, Wells Fargo faced rising loan loss provisions, causing its payout ratio to exceed 100%. The bank eventually cut its dividend by 80%, showing how financial instability can erode dividend safety. Tupperware Brands, TUP. Tupperware maintained its dividend despite poor cash flow and rising debt, only to eventually suspend dividends altogether. This is a clear example of a company borrowing to maintain dividends, which is a significant red flag. How to avoid dividend traps. Analyze payout ratios. Stay wary of companies with payout ratios consistently above 80%, unless they are in stable industries like utilities. Assess financial health. Look at debt-to-equity ratios, interest coverage ratios, and free cash flow to gauge a company's stability. Monitor earnings and cash flow trends. Consistent growth in earnings and cash flow is a good sign. Declining trends can indicate trouble ahead. Review industry trends. Avoid stocks in structurally declining industries unless you are confident in their turnaround strategy. Diversify your portfolio. Holding a mix of high-yield, growth-oriented, and defensive stocks can reduce the impact of a single dividend cut. Conclusion. Dividend investing can be a powerful strategy for building wealth and generating passive income, but it requires careful analysis and a vigilant eye for potential traps. By understanding the risks, analyzing key financial metrics, and learning from past mistakes, investors can navigate the dividend landscape with confidence. Remember, no investment is without risk. The goal is not just to chase high yields, but to build a sustainable and resilient portfolio that can weather economic storms. Stay educated, remain patient, and always perform your due diligence before committing to any investment. If you found this guide helpful, consider subscribing to our newsletter for more insights on dividend investing and financial strategies. Stay informed and invest wisely.